POV. You are every level of a synthetic CDO machine. Level 1. The loan officer. You are the hand that signs. You work at a regional bank in Ohio. Your job is simple. You give people mortgages. You don't ask too many questions. The form says they make $80,000 a year. You don't call the employer. You don't verify the tax returns. You just process it. Your manager told you the loan gets sold anyway. Someone upstream buys it, packages it, ships it somewhere. You'll never see this family again. That's the point. Your commission hits Friday, $340. You feel nothing. You process the next one. The machine needs raw material. You are the mine. In 2004, you sign 47 mortgages in a single month. 11 of those families will eventually lose their homes. You won't know that for 4 years. You buy a new TV. You sleep fine.
Hi guys, before we continue, I want to thank everybody that has been supporting this channel by subscribing, liking, and commenting on all of our recent videos. I want to say a big thank you to all of you, and in case you haven't subscribed yet, please do. No stress, no pressure, but I would really appreciate it.
Level 2. The securitization desk. You are the architect of something beautiful and fake. You work at an investment bank. Your title is Associate Structured Products. You are 26 years old and you haven't seen sunlight in 3 weeks. Your job is to take those Ohio mortgages and 1,000 others like them and bundle them into a residential mortgage-backed security, an RMBS. You don't call it a debt pile, you call it a tranche. It sounds cleaner. You sort the loans by risk. Top tranche, AAA, safe as a treasury bond, they'll say. Middle tranche, BBB, a little spicy. Bottom tranche, equity, the trash. The math says the top tranche can't fail unless the entire housing market collapses simultaneously. The math assumes housing prices never fall nationally at the same time. The math has never been tested. You don't write that part in the prospectus. You adjust one correlation assumption, the risk number drops. You file the paperwork. You get a $22,000 bonus. You are 26 years old. You take a car service home. You eat takeout sushi in the back seat. You feel like a god. You are the engine room of a machine that will destroy everything. You have no idea. Level 3. The ratings analyst. You are the stamp of God. Your job is to look at the RMBS and decide what letter it deserves. AAA means safe. AAA means pension funds can buy it. AAA means it is legally as trustworthy as the United States government. The bank sends you the model. You run it through your own model. Both models were built using the same assumptions that have never been tested. If you can't get us to AAA, we'll take it to Fitch. You get to AAA. You always get to AAA. Your firm gets paid by the bank to rate the bank's product. You understand, quietly, what this means. You never say it out loud. In 2005 and 2006, your desk rates over $300 billion in mortgage-backed securities. You give most of them AAA. The banks pay your firm hundreds of millions of dollars in fees. You go to a conference in Scottsdale, open bar. You get a tan. Level 4. The CDO manager. You take the trash and call it a trophy. Now it gets elegant. The bottom tranches, the BBB-rated trash from the RMBS bundles, nobody wants to buy them. Too risky. Too honest. So you take 100 of those BBB tranches and you bundle them into a new product. You call it a collateralized debt obligation, a CDO. You run it through the same models. You get it rated by the same agencies. 80% of the new CDO gets rated AAA. You have taken trash and made gold. On paper. The pension funds buy it. The Norwegian Sovereign Wealth Fund buys it. Midwest school districts buy it. Because it says AAA. Because they trust the stamp. Your management fee, 1.5% per year on a $2 billion CDO. That's $30 million every year for managing a pile of BBB trash that you renamed. You take a vacation in Sardinia. You have a second home. You are completely legal. You are also one bad housing quarter away from a global catastrophe. Level 5. The hedge fund analyst. You see the lie before everyone else. You are 31. You are not from old money. You got here with a calculator and a rage you can't explain. You've been staring at these CDO prospectuses for 6 months. You've driven through the neighborhoods in those Ohio mortgage pools, vacant houses, for sale signs, overgrown lawns. The loans are already going bad, but the CDO still says AAA. You bring it to your boss. He looks at you for a long time. He says, "How do we bet against it?" This is the question that changes everything. You ask for a credit default swap on the CDO, a CDS. It's insurance, except you don't own the thing you're insuring. You're just betting it burns down. The bank on the other end is happy to sell it to you. They think you're crazy. They think the model is right. They think housing never falls nationally. You pay a monthly premium. It feels like bleeding money. Month 1, nothing. Month 6, nothing. Month 14, the delinquency rates start twitching. You don't sleep anymore. Not because of fear, because you know you're right. And you know what being right is going to cost everyone else.
Level 6. The Synthetic CDO Architect. You build the machine that bets on the machine. Here is where it gets truly, beautifully obscene. The banks run out of real mortgages to bundle. There are only so many bad loans in Ohio, but there is infinite demand for the product. So they build something new, a synthetic CDO. There are no actual mortgages in it. It doesn't hold real loans. It holds credit default swaps, bets on the performance of other CDOs. You are now manufacturing the underlying asset from thin air. The hedge fund from level 5 is on one side of the trade. They want to buy insurance on the BBB tranches. They think it all fails. Your bank finds pension funds to sit on the other side. They sell the insurance. They collect the premium. They think it's income. Your bank is in the middle. You collect fees from both sides. You don't care who wins. You are not in the casino. You built the casino. You own the walls, the floor, the chips, and the dead. The reference pool on one synthetic CDO you structure is $2 billion, but the underlying mortgages it references, those were already packaged into 3 other CDOs. The same loans are being bet on simultaneously by 5 different synthetic products. 1 default becomes 5 defaults. 5 become 25. You know this. You order dessert. Level 7. The risk officer who says nothing. You are the last door and you leave it open. Your title is Chief Risk Officer. You have seen the exposure reports. You have seen the correlation assumptions. You have seen what happens when housing falls 15% nationally, a scenario the model calls virtually impossible. You have flagged it, twice, in internal memos that went nowhere. You are not ignored. You are managed. Your compensation is tied to the desk's performance. The desk made $4 billion last year. You made $3.2 million. You buy a house in Greenwich, private school for the kids, a membership. You update the memo. You use softer language, areas of monitoring, ongoing sensitivity analysis. You do not say, "This will destroy us." This is the level most people never talk about. The machine doesn't just run on greed, it runs on people like you, people who know, people who stay quiet because the quiet costs $3.2 million a year. Level 8, the collapse. You are every person who watches the screen go red. It starts with a number. Delinquency rates in the subprime pools hit 20%, then 25%. The model said this was impossible. The model is not here right now. The BBB tranches get downgraded overnight. The CDOs holding those tranches get margin called. The banks holding the CDOs have to post collateral they don't have. The synthetic CDOs detonate in sequence. Each one triggers 5 more. The hedge fund from level 5 is printing money. Everyone else is drowning. Lehman files Chapter 11. AIG needs $85 billion. The commercial paper market freezes. Money market funds break the buck. The entire global credit system stops breathing for 72 hours. She packs a lamp. She packs a photo frame. She leaves the key under the mat because the bank told her to. You, at every level above her, made millions, were bailed out, returned to bonus cycles by 2010. She rents an apartment 40 minutes from her kid's school. She qualifies for nothing. The machine needed her to fail. It was designed for her to fail. You just kept it running. Level 9, the aftermath. You are the system that learned nothing. One banker goes to jail. 1. In Iceland. In the United States, 0 criminal convictions for senior executives. The banks get $700 billion in TARP bailout funds. They pay it back with interest from the cheap money the Fed gave them. They call it a success. By 2013, Wall Street bonuses are higher than 2007. The synthetic CDO desk at one major bank reopens under a different name to comply with new regulations that don't prohibit it. They just regulate the font size on the disclosure. The lesson was not, don't build this. The lesson was, build it better, hide it deeper, make the model more convincing. The Dodd-Frank Act passes, 47 pages of carve-outs, lobbied into existence by the same banks that built the machine. The carve-outs are longer than the restrictions. You, at every level of this machine, were not the villain of a movie. You were a node, a function, a rational actor optimizing for the incentive in front of you. The loan officer needed the commission. The analyst needed the bonus. The ratings firm needed the fee. The risk officer needed the mortgage on the Greenwich house. The architect needed to be the smartest person in the room. Nobody burned down the world on purpose. They just kept signing, kept modeling, kept stamping, kept their mouth shut. And somewhere right now, in a fluorescent-lit cubicle, someone is signing a form, not asking too many questions, feeling nothing. The machine is never off. You were every level of it. You always were.